The Enron Scandal by Stuart Swartz. Enron's rise. Kenneth Lay, shown on the right, merged natural gas companies Houston Natural Gas and Inter-North in 1985. Enron became the largest seller of natural gas in North America by 1992. From 1990 through 1998, Enron grew by 311%, which was slightly above average. But however, in 1999 through 2000, Enron's growth was way above average. 56% in 1999 and 87% in 2000 compared to the index of 10% increase and then 20% decrease. Why the sharp growth? New CEO Jeffrey Skilling takes over Enron and begins implementing new tactics to keep the appearance of high revenue. Aggressive accounting style. Enron began marketing the entire value of every trade it made as revenue as opposed to the conventional fraction of the value. Market-to-market accounting. The income for long-term deals is recorded once the contract has been signed. Cash might not be received for several years, but it is recorded as revenue immediately. Creating separate corporations to hide debt. CFO Andrew Fastow owned many private companies that Enron would sell assets to so it could report revenues when the assets technically did not leave the company. The collapse of Enron. With the market-to-market accounting, Enron had pressure in future years to keep profits high. Enron must find new sources of revenue because all the long-term revenue was accounted for when the deal was originally made. Enron begins hiding debts in 1997, revealed by a fortune story in February of 2001. CEO Skilling retires in August 2001, the sixth senior executive to leave within a year. The already highly overrated stocks begin to plummet. The market cap for Enron was 70 times its earnings, and investors became uneasy about the lack of understanding about the Enron bookkeeping. The collapse of Enron continued. In October 2001, Enron admits accounting errors, lowering income by $586 million since 1997. Their credit rating comes under consideration. This is very important because if Enron's credit was lowered, it would force them to issue more stock to pay for loans, which would further lower the value of their stock. 1 month later, Enron files for bankruptcy. A criminal investigation is launched against the major company leaders, including Fastow, Skilling, and Lay. Major players include Kenneth Lay, the founder and CEO for some time, Jeffrey Skilling, CEO and major contributor to fraud from 1997 to 2001, and Andrew Fastow, CFO, creator, and owner of many of the shell firms. Andersen Accounting Firm, Enron's auditor firm, perpetrated many of the bad accounting practices and was dissolved. Stockholders and low-level employees were duped into believing the prosperity of Enron and lost billions. More than 80% of employees' pensions were in company stock, which fell from above $90 to less than $1 in a year's time. Main issues. The ethical issues include the executives lying to investors and to Wall Street. The legal issues are Lay, Skilling, and Fastow all facing huge lawsuits, including major jail time, and Andersen Audit Company being dissolved. Professional issues include Andersen and Enron using loopholes in GAAP to lie to investors, and the social issues include strong Enron lobbying